A very good evening to you, team. It is Thursday evening. The bank has had the MPC meeting today, and it's no massive surprise that we've held rates at 5.25%. In all honesty, I wasn't planning on doing a live after this meeting, because there's not a huge amount to talk about. But when I actually read into the narrative and saw the sort of the post-meeting interview, some of the words that were coming out of the governor's mouth made me sit up and pay attention. So what I wanted to do was I wanted to go live. I don't plan on this being a long one, but go through what the narrative was, what that sort of forward, no, it's not a forward forecast, but what he's implying as a forward forecast is. And we can break that down a little bit and see how that kind of feeds in to where the property market is going to be going. So where interest rates are going over the medium term and how that's going to impact the property market over the next sort of 6 to 12 to 18 months. And we can have a chat about that. So if you are watching on the live, a very good evening to you. Please put all your comments in, give me a thumbs up and put something in the comments if you can hear and see me because we are live. If you're watching on the replay, as always, team, please put your comments in as well. And I'll always come back and chat to you about it. So first of all, what are your thoughts? Stick them in. About the hold, was the hold the right decision? Were you expecting the rise? Were you expecting the hold? I don't think anybody was really expecting a drop, although some people have been talking about it, but that looks like a very long way away. So what I'm going to do is I'm going to dive straight into it and talk about, I'm going to break this down into various things that the governor said afterwards about inflation, about the economy, and about interest rates. And we're going to try and understand what's actually going on. So here's the first thing. So, he's made a pretty bold statement. I don't know what data he's seen. They don't seem to ever be able to get it right anyway. That inflation is going to be falling to sub 5% in this month's print. So November's print is going to look at October. If you remember, we're at 6.7% right now. And we're talking about CPI, not CPIH. So I think it's pretty easy to get CPI down when you're stripping out the H bit, which is the bit that's going up quite a lot. But anyway, regardless, he's predicting sub 5%. Now that means we're going to need a 1.7 to 1.8% drop month on month to get there. That's a large drop. We are expecting a large drop, as we talked about a lot. So if I go into the data that we have been covering really for the last few months now, if I just give me a sec. So I get my draw track, if I can find that, drawing. Right, if you remember, it's this figure here, which is the month-on-month 2% increase we had on CPI month-on-month last October. And that is actually falling out of the data set this year. So this month, when we looked at Sunak's pledge to get the inflation to 5 or half inflation, which kind of get it down to 5%, I think technically it's 5.1%, they would have always seen this data and seen these big amounts of month-on-month figures dropping out this month, which means Sunak's pledge to get it to 5% should be quite achievable. Now, my only issue with this is we're at 6.7% right now. And if we look at the month on month, that's been accelerating over the last couple of months. So last month's month on month was 0.5%. If we're anywhere around that 0.5%, then it's going to be actually, even with the 2% dropping out, it's going to be difficult to get it sub 5. Now, I know it's not quite as linear as that, but I think it's a bold claim to be saying we're going to be sub 5% in this month's print. I'm going to be interested to see what happens. Now, again, if you remember, if we look at then the next quarter, okay, and I'll just zoom in on this, month on month, we've got over the quarter, we've got a 0.4% net increase in CPI that drops out over the next quarter. So this is where we think it's going to get sticky. So I've always said this month, i.e. November's print, we're going to see a good drop, whether or not it gets below 5%, we're not sure. Then the next quarter after that, we think it will be persistent and sticky inflation, depending on obviously what happens with the month-to-month going forward. So that's something we need to bear in mind. And I reckon that feeds in to the rhetoric that we'll talk about in a bit, to Bailey's rhetoric. So that was what he talked about with inflation. Let's MB that. There are some discussions about the labour market. So what obviously is happening is people are uncertain of what is going on with the labour market right now. Now, if you remember last week when we talked about this, and I looked at the labour market stats, and on the website, on the ONS website, it talks about using experimental methodology because the responses to the labour survey were so low, it's kind of sent everybody into a panic, and they've had to use a backup method to assess the actual labour stats. So we kind of have that image that they're flying blind a little bit, and the ONS hasn't really got an accurate way of reporting what the labour market is. In fact, if we look at this question that came in afterwards, I mean, the terminology here is disaster. What effect has the disaster at the Office for National Statistics over its data collection of labour market stats had on your work? Okay, so of course he's going to spin this, but what we're seeing here is that we've got really unreliable labour stats. So we talk about the unreliable labour stats anyway, based on how they employ or how they count somebody as employed, self-employed, 0 hours contract, all goes into that employed bucket. But we've seen that softening of the labour market. But how much, we're not sure. So that's another interesting thing to take into consideration. And then here's the thing that really sort of got my attention was talk on the economy. Okay, so this is some of the comments that came out today. UK recession is now 50% risk. Bearing in mind, it was not long ago they were talking about we're going to avoid recession. Okay, 50% risk. And by the way, these are sort of sound bites, if you like, that I've just captured today to go through this. I'm just going to look at this. This is from Bailey's mouth. The British economy is going to be flatlining for the foreseeable future, with next to no economic growth all the way through until early 2025, according to a bleak set of forecasts from the Bank of England. Okay, so the bank has cut the growth forecasts to nothing for next year, for 2024, and pretty much nothing for 2025. So they're basically saying UK economy is going to be the same size basically this time in 2 years' time. So in 2026, going into 2026, we're going to be the same size as we are now. Now, this is very different to the narrative that's coming out the government's mouth, obviously, which is that, oh, look, Blue Book 23 has found all this extra GDP. We're actually strong. We're actually growing. I saw Hunt react immediately to this and say how delighted he was with this set of figures. But when we look at the narrative, we have to see this is an inflection point in the economy, right? And if I just come off this a minute, you can see that they're between a rock and a hard place, or my feeling is they're between a rock and a hard place. My thoughts are they don't want to put the interest rates up. They feel they probably need to with where inflation is. They're trying to spin it as much as they can. They feel like they probably need to go a little bit higher, but they don't want to because they don't want to break things. And they're saying the economy is in a pretty dire place. And actually, to be coming out and saying the economy is in a dire place, the labour market is softening, but we're not really sure exactly by how much. And not to be looking at lowering interest rates, I think when you read between those lines, right, that's actually quite a powerful statement that's being made that interest rates are staying as they are. I'm also going to talk about potentially answering to their lords and masters in the government about interest rates as well. Look, before we do that, I'd like to ask you a favour, team. I do this every time. Those of you who watch the channel regularly, welcome back. Those of you who are new to the channel, I only ask this one favour, and that is to help me grow this channel, because I've got a vision with this channel to deliver unbiased, impartial, data-driven analyses of what's going on to enable you or to empower you to take control of your own financial future, whether that's in property, whether that's in business, whether that's in other asset classes. The favour that I'd like to ask you is to help me do that. YouTube loves subscribers. So if you could subscribe to the channel, it's going to help me grow the channel, which will give me more resources to put on more shows, put out more content, more training. It's the only thing I'll ever ask you. So please, if you're new to the channel, or if you're returning to the channel but you're not subscribed, please do subscribe to the channel, because there's only 0.01% of views on the channel end in a subscription. If we could just get that to 0.02%, YouTube's going to love it. It's the only favour I'll ever ask you. Right, let's get back to it. And by the way, just so you know, what I'll do is I'll go through all these slides, then I'll come to the questions afterwards for those who are watching on the replay. So GDP is not looking good, right? 50% chance of a recession. Some interesting questions that came to Bailey about insolvency figures. I've not spent a huge amount of time, but I'll be dedicating more time to this over the coming weeks, looking at insolvency figures. Numbers of firms in England and Wales going into insolvency in August has gone up by 20%. Fairly significant increase. And actually, we have been seeing some increases in insolvencies throughout 2023. So I think that's kind of showing where we are, as an economy. And a lot of this, of course, is because companies are being removed from that, lifeline or that water hose of cheap debt. It's very difficult, not just to grow, but if a lot of companies are saying stagnant, they're often going to sort of go into reverse. So that was an interesting stat. And then good question here. You painted quite a grim picture of the UK economy. Given that you think it takes up to 18 months for interest rate rises to have their full impact, isn't there a danger of falling behind the curve? Now, this question is saying to the bank, look, you think the economy is flatlining if not going into recession. And we're still only halfway through the effects of the original interest rates coming in. So do we actually need to start reversing? I saw an increasing amount of narrative and commentators saying, actually, we now need to start cutting interest rates. Because the interest rates that are in right now are not had their full effect, and we could see a really horrible economic situation come on if we stay where they are or carry on going up. It's really going to start to grind that economy into the ground. Of course, when we grind the economy into the ground, when we go into a proper recession, I talked about this yesterday and I've been talking about it for the last few months, the big trigger that's going to impact the UK property housing market and take it from where we are now, which is a slow and steady correction to that full-on market crash, is probably unemployment. Okay. Unemployment and the inability to service the now much increased debt that people have in terms of mortgages is probably the one key factor that will turn that switch and pivot the correction to a crash. So some people now saying, look, we need to start looking at backtracking this. Of course, with inflation where it is, they just can't do it, which is why they are very much stuck behind a rock and a hard place. It also does say, by the way, if you look at here, the bank agreed, by the way, the bank agreed that we're approaching halfway point on the transmission of its previous 14 interest rate rises. I mean, that's fairly interesting to see the bank saying that. They're saying we're only feeling the effect now of the first 7. So we're kind of literally feeling the effect of what? That takes us like 2.5%, 2.6% in terms of the actual interest rates, what we're feeling now. 0.1 to 2.6, I would suggest, is completely different from 2.6 to 5.25. I'm kind of looking at that halfway point roughly here. I would suggest, there's that sort of, we have a law of diminishing returns, but in this case, it's almost the opposite. It's a law of compounding distress, right? You can take an increase in interest rate if you've got debt to some point, but then it's going to hit a breaking point, and it's just a very linear breaking point for a lot of people. It's like, at this amount of debt serviceability, I can service it. It goes above it, I can't service it. And because of stress testing, as the interest rates go up, a lot of businesses, a lot of homeowners, whether it's mortgage, whether it's credit card debt in businesses, whether it's loans that they are servicing, can service it up to a certain point. We're not even, we're only halfway in terms of that effect being felt. So that is a pretty compelling argument for the economy to be going into recession fairly soon. And we've gone fairly quickly from we're going to avoid recession to it's now 50% chance for recession. Look at the trends. Always look at the trends, look at the breadcrumbs, see where that is taking us. All right. Those are the narrative on the economy. Let's have a look at the narrative on interest rates. As property people, of course, this is where we're really interested. What's going to happen to interest rates? I put in the title of this, bad news for property prices. On the face of it, holding interest rates for two months in a row is good. It's like, right, we're at the top, right? They're holding it. We're not going to go up anymore. I'm now hearing this term used more, which I think has been coined by somebody on the MPC, of climbing Table Mountain. And what effectively they are saying here is we're going up and then we're flatlining. If that's come off, we're going up and then we are flatlining for a long time. And the narrative that came out of the bank today is very much backing up that sort of metaphor, if you like. And I've always said, I've been saying it for the last 3-4 months, go back and look at every single video. It's not about where we peak. It's about where we settle and how high it stays for how long, because we're in this race. We're in this race with liquidity versus interest rates staying high. And it doesn't matter if we peak at 5, 5.5, 6, 7. If we stay at 5 for years, right, this is going to be grinding people into the ground. This is going to be grinding mortgage holders into the ground, grinding businesses into the ground. And this is what they're talking about. So let's look at the narrative that came out. Talking about the first thing is talking about the pain for mortgage holders. So again, the bank has said that their analysis suggests that little more than half of the pain of interest rates has yet to be felt among households. And we've been saying that there's still over 100,000 people every month coming off cheap fixed rate mortgages of 2% or more. The forecasts are 1.6 people are going to be coming off their fixed rate mortgages by the end of 2024. So that's another year and a half. So another 1.6 million people feeling the pain. So there it goes. It says that higher interest rates are nonetheless weighing increasingly heavily on the economy, with investment down, consumer spending down, and housing spending down. Don't forget, I know I'm flicking about here. If we look at our little wagon wheel down here, fall in wealth, lower spending, gets our fall in GDP, fall in house prices. It's all symbiotic. Always said this takes a while to filter through. This will take, this is taking years. This is a glacial cycle that's happening, which is why I'm not so concerned with month-in-month fluctuations in house price indices, ONS data, labour data. It's about the trends, right? And that narrative for me got a hell of a lot worse today. Right, let's go back to what else, the other things that he was saying. Right, so this question, is your message that you don't see any reason to cut interest rates in 2024 given the path of inflation? So it's looking increasingly, their narrative is increasingly that interest rates will not come down next year, 2024 at all. Bailey says the message we're going to have to maintain policy in a restrictive stance as it is in order to get all the way back down to target. So they're saying they're not necessarily going to go up a lot more. They're going to leave it open to go up if they need to. So for example, if in the first quarter of next year we see that secondary inflation, which I've talked about is a potential, looking at the data dropping out or the month-on-month dropping out from last year's data set. If we see that secondary inflation, they're leaving the door open to go up. But they're saying it's unlikely we're going to go down. Now, we did a session. When was it? Sorry, I just hit the microphone there. We did a session last month where I talked about the potential scenarios. And my prediction was the very earliest would see an interest rate drop sort of summer next year, because we'll have that stickiness in Q1. If the month-on-month continues where it is now, or roughly where it is now, we'll see that stickiness in Q1. Q2, we're then going to see, we should see the inflation come down unless the month-on-month goes up significantly. And there are geopolitical factors out of our control here. For example, Gaza, Middle East, Russia, and Ukraine. But given the trends in Q2 of next year, 2024, we're likely to see the inflation come down a lot because of the 12-month, month-on-month dropping out, if that makes sense. And that would probably be the earliest we would see a interest rate reduction. So I said at the very earliest, we're probably looking July, August next year for the first drop. They're now talking potentially, and of course this is all forecast, and they do caveat saying it's very difficult to forecast this. Could well be nothing next year at all. So, that's going to cause a lot of issues for people. Another question, Andrew Bailey then denies that the bank is pushing back against market expectation of a cut of interest rates by next August. So interestingly, the market sort of agreed actually, August. But he says there's been no discussion about cutting rates, and the bank thinks rates will remain where they are for an extended period of time to bring inflation back to the 2% target. So I don't know if this is good news for people or not. I think it's not good news for the housing market. Okay, so he thinks that, as I said, look, we got upside risk to inflation rather than downside risk. Brent crude he's talking about. We've talked about Brent crude a lot. Obviously, it spiked up again last week with Gaza. It's come back down to about 85. But that 85 is still 20% higher than it was in the summer, right? And that's still feeding into the supply chain. So they're basically saying they need more data before it comes down. Now, something I do want to talk about is the bond market and the impact this may have had on the rate today, or the meeting today. So we did a piece of in-depth analysis on this last week. So I'm not going to go over that in-depth analysis today. If you want to catch that, then go back and look at the last couple of lives. I think it's two or three lives ago. We talked about what the bond market is, right? How it works and how it affects lots of things, basically. And if I zoom in here, impacts from bonds is if the bond market is in turmoil, which it is, which basically means if the yields are going up and therefore the values are going down, and I'm not going to explain to you how that works today, it's bad news for stocks, which is interesting. Stock market had a good day today, which is probably them reacting to not raising interest rates. So there's an inverse relationship. It's bad news for banks. So especially if you think about Metro Bank, who had issues last month, they've got a big bond portfolio they have to refinance next year. It's going to be more expensive for them. One of the big things is bad news for the government. We'll talk about that in a sec. But effectively, with bond yield soaring, this is doing a lot of the work for the central banks, okay? Because the Bank of England base rate is not necessarily the interest rate that a lot of is affecting a lot of people. So bond interest rates or bond yields are going to be affecting other people more than potentially the Bank of England base rate. So if we look at where bond yields have gone over basically this year, they're spiking up. And this is both sort of European bonds, US bonds and UK bonds. Let's just call them bonds rather than the individual things. They have been spiking up. Effectively, what this means with yields spiking up is that the value of the bonds devalue horrifically. At the moment, the Bank of England is selling off their bonds as part of their and somebody corrected me on this, Ramjam, I think it was. Thank you for that, Ramjam. Quantitative tightening policy, which effectively means they're offloading their bonds, which they bought during the QE, let's call it the QE process. And because the bond yield's gone up and the bonds have devalued, they're making massive losses. Now, UK Treasury has got a clause that when effectively it bought these bonds to put pump money in the system, they have to cover any losses that bank incurs selling them. So right now, the bank are offloading all of these bonds, which have been devalued hugely, and the Treasury is soaking up the cost of this. This is costing us as UK PLC, as the Treasury, a huge amount of money. So when we look at this, right, at the moment, the Treasury is paying billions to cover the costs of these. And you can see this black line here. Now, this is obviously June, July, August. The black is the OBS trend or prediction, and you can see we're over that. So in August, we're almost 30 billion of losses we're plugging. Not seeing the data for September or October, but when we chart this out, and this is as well as covering these losses, clearly with the interest rates going up or the yields going up on these bonds, it means the serviceability of them is also going up. This is a predicted chart of UK PLC Treasury servicing their debt pile, and this is where we are now. Okay, and this is where we're predicted to be in only 4 years' time. So that's an increase of almost 8 times over the next 4 years of servicing that debt pile. This is clearly totally unsustainable for the UK PLC, for the UK Treasury. And so therefore the pressure for them not to have interest rates continue to go up, right, and increasing this debt pile must be significant on the bank. So I would imagine this is also a major factor that's going in to the MPC policy making. So for me, and look, this is a hypothesis. It feels like they are stuck behind this rock and a hard place. It feels like with the narrative, they feel like they need to go heavier. They feel like they need to go harder now to try and just stamp this out, get rid of the sticky inflation and bring it back down. And actually, shorter, sharper, higher shock, bring it back down might be better. But because of this pressure that they can't just keep on putting up, because it is going to break the economy and break the Treasury and break a lot of people, it's almost like they're being capped now. And that table mountain, if you think about it, I need a slide to draw this on really. Effectively what we're doing, let me just draw on this, see if this makes sense. Rather than having something like this, okay, what we're doing is that. And this makes it longer and more drawn out. And because we've got this race of liquidity, that I suspect having it longer and more drawn out, but sort of capped at the top of how high we can go, it's going to cause a lot of people a lot of issues over 2024. So where's that leave us? Where's that leave us going into the next 12 months? Because I think we've got a pretty clear direction there, or a pretty clear overview of where we are from the experts, from the governor. This was a little article I saw on the Sky website that came in this morning about 10 o'clock before the interest rate announcement. And it's an optimistic view. Okay, so this is a research consultancy called Pantheon Macroeconomics, just to credit them, who said their expectation was, let me just, get that off because I think I've just written over their expectation, is that the rates are going to come down sooner than the economists we quoted. They say we expect a material recovery in the housing market next year, 2024, as the MPC start to reduce bank rate by 25 basis points at alternate meetings from May. So before the interest rate and the narrative came out, some research groups saying, right, May we're going to start coming down. It's going to put stimulus to the housing market. And actually, they say at the bottom, which I think is really interesting, lower mortgage rates alongside modest growth in households' real disposable income should enable prices to recover most of the ground lost since August 22 by the end of 24. So we've got a research consultancy saying by the end of 2024, we'll be back up to the peak in the housing market. I'm struggling to find a lot of agreement with that, or a lot of data that shows me that that's going to be the case. I'd love to hear your thoughts on it. Put it in right now in your comments what your thoughts on that particular article are and why we think they've said that. What actually I think is more of an accurate narrative is the MPC's latest projections indicated that monetary policy was likely to need to be restricted for an extended period of time, and there's further tightening needed if there's evidence of persistent inflationary pressure. So just that's as an overview. We're held at the moment because I think nobody really will allow them to go much more. But if we get secondary inflation, they're going to have to go up. So we're kind of talking about that. That's what the bank said. Here's an interesting one. Experts now predict rates could stay above 4% until 2029. That's a long way away, 2029. I'm going to be almost 50 by then. And yes, thank you. I know I don't look that old. But there we go. So that is the... Oh, sorry, I wasn't even putting that on the screen. My bad, team. I'll just put that on the screen quickly. just to show you. So we had the Pantheon economics article there, just so you can see the source. And then we've got the experts predicting rates could stay above 4% until 2029. Don't forget, IMF recently in the October State of the Global Economy suspected that we could even be above 5% until 2026. So I think we are staying higher for longer, as we've been talking about a lot. For me, that means this protracted draw out, especially in terms of real house prices, I still think is going to be 5 to 7 years. Nominal more difficult to call, so a lot of that will depend on nominal wage growth overall, which some people are saying is peaking. The absolute key to this now comes to the state of the economy. And if we start seeing unemployment go up, which we're not at the moment, but if we do, I think that's going to be the trigger. So that's where we are. So actually, even though a fairly dull announcement with sticking at 5.25%. And by the way, what is also interesting is how we as human beings normalize things. So all of a sudden, like sticking at 5.25% is a good thing. It's like, oh, it's normal. We're at 5.25% now. Imagine if 12 months ago we would have said sticking at 5.25% was going to be a win or going to be a normal thing. Because a lot of people were saying that above 5, we're effectively starting to break things in the economy. And actually, that's one of the things the bank said, that they have basically a neutral interest rate, where if you're below it, you're stimulating the economy. If you're above it, you're grinding the economy. And they actually said today that we're above it at 5.25%. We are above that rate, so we are grinding at the moment. Lovely. That's the reaction to holding the interest rate. Who'd have thought we could have got best part of half an hour's discussion on that? Let's see what the comments are. We'll go through them. By the way, give me a thumbs up if there's some useful info in there. Give me some comments if you want to put your point of view on, and if you've got any questions, get them in now as I go through. Darren saying inflation still way too high. Agreed. It is Darren. Mark, Sunak was always going to get his half inflation. Makes you wonder who's pulling the strings. Yeah, we've talked about this a lot actually, Mark. That when you look at those figures dropping off, I firmly look. It's easy to sit here on YouTube and say the people who run our country are muppets, right? They have no idea what they're doing. They clearly are not muppets, right? People are not stupid who run the company. They might be out of touch, but they're not stupid. They also might not have the populace's best interests at heart. They're probably, quite self-absorbed and focused on their own agendas, but that's more dangerous than anything, right? So all of these figures have not just been plucked out of anywhere. He's not just woken up one morning himself and gone, let's halve it by the end of 2023. He'll have had a team, right, of analysts and economists crunching numbers, looking at this data and going, look, we can get this, fairly easily because of these reasons. So, obviously banks meant to be independent. Let's face it. It is not. It is not. Lovely. Let's take that off. Becky says, house prices have already dropped by 10% due to the lag in the data. Yeah, this is interesting, Becky. So I actually saw another channel. It's one that everybody will know and probably are quite endeared to in the property market, talking about the difference, the discrepancy between the HPIs, house price indices, ONS, Nationwide, Halifax, and the reality. And I'm inclined to agree with that narrative that these figures that come out on the HPIs are models, right? They're not actual house prices. It is a model that data gets put in, and nobody knows exactly, but we can break it down, and we will do break down how they work out those models or the factors that go into the model. But ultimately, it is a model. It's not just taking all the house prices and taking that's the average that's sold. Okay, so that's which is different to Rightmove, by the way. Rightmove data is just listings, new listings, so it's actual objective data, different. On the shop floor, because we're very active in the property market, we're buying at the moment. I've literally not seen deals like we are seeing at the moment, an opportunity like we're seeing at the moment for 10 years. Since I got started in 2010, right? After I actually got started in 2007, but I got started seriously and properly in 2010 because I lost money in the first crash of 2008. Learned all the lessons, and then started buying when we sort of bottomed and troughed. So seeing opportunity, not that we've seen since then, effectively. And there feels a real disconnect between the data that's coming out on the HPIs and what's happening on the shop floor. So next week, I'm going to do a live analysis of the opportunity. So I'm going to look at the portals. I'm going to look at price reductions. I'm going to look at discounts, all that sort of stuff. and try and get a bit of a better feel to the shop floor what we're actually seeing, rather than necessarily just what a model that somebody has put together says. So I think that's interesting. So thanks for that, Becky. Yeah, Mark saying, whilst it's not very nice for mortgage holders to be held to ransom with higher mortgage payments, they are stress tested for higher rates at the front end for this very issue. Yeah, you're absolutely right, Mark. They are, and I put out in a video this week that the stress testing criteria actually changed 2015. So they're being stress tested quite high, and then I believe we're roughly sort of 8-9% stress test in terms of mortgage now. So people have a mortgage, they should be able to afford it, unless they lose their job, which is why the unemployment is such a major factor as to the future route of the house price market correction / crash, however you want to look at it. Tipa, how are you doing? Team, amazing. There we go. That's the data. That's the data today. If anybody's got any more thoughts on that, please let me know. Next week, I'm fairly sure we're going to get the Halifax HPI come out. So even though, as I just said, we've got to take it with a pinch of salt, it is also giving a trend, and it's the trends that we're interested in rather than, I think, the actual figures. So we'll analyze that live next week, and also I'm going to jump on live and do this analysis of what we're actually seeing on the shop floor. I think that'll be an interesting exercise for us to do. Cool, team. If we've got no one... Oh, sorry. I've got Gordon. Viewed 6 houses in the last 2 days in Kent. Managed to speak with one agent who told me they'd never had so many properties for sale. Total of 54 in one office. Yeah, that's interesting, Gordon. So let me just flip something up, just to kind of back. It could well be. One of the issues, I must say, with agents is they have... I'm not saying this one is the same, by the way. They have such a regular turnover of staff, and especially younger staff, that a lot of people at the shop floor, especially if they're new into a estate agency, probably haven't seen anything other than the good times. They probably didn't see sort of 2008 and go through that. If we have a look at this, which is last month's RICS survey, we can see that the average amount of stock per branch is on the increase. Now, of course, this is an average. This is average across the UK. It's going to be different in regionals. I haven't got the regional breakdown in front of me, but we can see it's on the rise. However, it still is at pretty low levels as an average. Okay, across the country. As I said, trends are everything. We are seeing for sure an increased amount of stock, but when we went through the Zoopla figures, I'm just going to see if I've still got those Zoopla figures here in front of me. I do try and keep everything on the slide deck so we can go around, but I may have lost them for some reason. Yeah, it must have got shuffled a little bit as I made the slide deck. One of the things that the Zoopla HPI said last week, was that the flow of new supply is in negative. Again, this is UK, this is an average. So you've got to take it with a slight pinch of salt, but we've got a negative reading on the flow of new stock, which just means the whole thing has crunched up at the moment. Average stock per branch is going up by about 25% month on month in terms of, which means the stock they've got is not selling. But we're still not seeing that influx of new stock. And it's that influx of new stock which will only happen if we get into forced seller territory. Forced seller territory, the biggest trigger of that is unemployment. So I keep saying the big trigger, the only thing I think that is holding everything up right now is the fact that the labour market is still tight, that unemployment is low, however we want to look at those stats. And don't forget, we've also got the bank's charter to not start repossession for 12 months. And we're not even anywhere near 12 months since that charter was put in. So therefore, we're not seeing those forced sales at the moment because people do not have that pressure on them. That could change next year, depending on what happens with the economy. Okay. We have seen, by the way, when we look at the arrears and possessions data, that we're seeing a very, very obvious uptick on arrears. So that only comes out once a quarter. I'll be very interested to see Q3 of this year, because Q2, certainly in the buy-to-let sector, showed 126% off the top of my head, year-on-year increase in arrears of people in the 2.5 to 5% bracket. Massive. That's a huge increase. Okay, there we go. But yes, Gordon, I agree with you. Things are not selling. There is tightness. And by the way, if things are not selling and there's tightness, for people who do need to sell, that motivation is going to be higher. So anybody who's in property as investor, developer, please don't think that we cannot be investing and developing this market. This market is where, for me, opportunity is. as we see a huge wealth transfer, but primarily in that sort of more sophisticated investor sell-off. So baby boomer landlords style institutions selling commercial stock, that sort of stuff, rather than homeowner distress sale. All right, team. I hope that was useful. It's been a pleasure as always. I wish you all the best for the end of the week. Have a great weekend. And next week, I look forward to talking to you about Halifax's data. And we'll go through that exercise to see what's going on the shop floor by looking at the motivation on the portals. Have a great one, and I'll see you very soon.